Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, number 68, all about annuities. There's my disclaimer: facts and figures, information only. This is not advice. Okay, purchasing an annuity. So this is something we could do with the money from our super. It could be money that we've done from our savings. Literally what we're doing is we're giving money to a company so that they then give it back to us as a guaranteed regular income for our lifetime, or perhaps for a chosen investment term. You might only have it paid for 5 years or so. But the idea is that it will give you a regular income for a term, be it something you've chosen, or the rest of your life, giving you peace of mind that you know that money is going to be coming to you. Now, of course, because you've given this company money, they can use that money and they will then turn around and they will give you an interest on this money. So it's not like you're just getting your money back. You're getting the money back with interest. And of course, it depends on what interest rates are doing as to the level of interest you would actually get paid. So at times when interest rates are very low, yes, you're not going to get a great deal of interest on these annuities. In times when interest rates are higher, this is where it becomes very difficult when buying a lifetime annuity, understanding what sort of rate you would actually get over your lifetime, as interest rates would indeed vary. Now, the idea of an annuity is, it's generally speaking not the normally someone wouldn't just have an annuity. Some people might, but just to give them that certainty. But generally speaking, it complements other investments. So you might indeed have a pension coming from your super. You might be getting an age pension, and you're just supplementing it with this annuity to give you some sort of certainty to your income there. So it just means that because if you choose a lifetime annuity, then you know that your money, you're not going to outlast your money, that the money will just keep on paying from this annuity for as long as you're alive. So you can invest some of your savings that you were paid in to get this guaranteed regular payment for a fixed term, some of it for a lifetime. You can basically just choose the sort of annuity that you wish. You could have one of each if you really wanted to. But the best part about the annuity is that doesn't rely on share market. Because when we start talking about allocated pensions, account-based pensions coming up in future sessions, we have to sort of still can take into account what the share market is doing. With an annuity, this is the whole point, is the fact that we're giving our money to a company, they take on the risk, and they then offer us this interest rate. So they're the ones that are sort of saying, well, gee, we'll give you, a 4% interest rate or whatever it may be. If things go well for them, then they, if their investments go up, they do okay. If investments fall, they are taking the risk. But you get your income guaranteed, irrespective of what the share market is doing. You've signed up for a guaranteed return, and that's what you're going to get. Now, another good advantage of an annuity is the fact that generally only around about 60% of the value of the investment is counted towards the assets test for settling purposes. So just imagine that you've just got a little bit too much money and it's pushing you over the threshold so you don't get any age pension. By taking some of your money and buying an annuity, then your assets have actually gone down, and you may then start getting an age pension. Or you may already be getting an age pension, but some of your assets are reducing your age pension amount that you're getting. By buying an annuity, your assets go down, but therefore you would indeed perhaps get more Centrelink, because then it comes down to income, and so it goes on. So there's all sorts of balancing acts to do here with anything to do with our Centrelink, obviously. Now, the lifetime annuity is exactly that. It is lifetime. So if you live to 105, this thing will just continue to pay you to 105. Some are worked out on life expectancy, and so be careful of a life expectancy annuity compared to a life annuity. And of course, there's also just the one that the fixed term. But with your life annuity, if you had a younger partner, then you could indeed, if you wish, include them. So if you pass away, they get the annuity, and so it goes on. Generally speaking, obviously, if they're a lot younger than you, therefore the term would probably be a lot longer. Generally speaking, you'd probably expect to get a lower interest rate from the company there. A fixed term annuity, you can choose, most companies, somewhere between 1 year and 50 years is what you could choose. And you could have yourself, you could pay yourself monthly or quarterly, half yearly, or even just one annual payment. That might be just your holiday fund that you've set up. But 50 years, yeah, look, I wouldn't mind to have a 50-year annuity thinking that I was going to outlast it. Generally speaking, you can have a minimum for an annuity of around about $10,000 is usually the smallest amount of money that you can have to start an annuity. You can start it with money from a super fund, or you can start it with money just straight out of the bank account. It doesn't really matter. There are impacts on taxation depending on where the money comes from, but effectively you can't have an annuity, generally speaking, with less than $10,000. So the income that you get from an annuity is tax-free if you use your super money, but if you invest with normal non-superannuation money, then the part of it actually is indeed taxable. So there's a bit of a distinction there as far as the income is concerned, depending on where the money came from in the first place to actually buy this annuity. Now you can have your payments fixed and have that fixed for guaranteed forever, or you can have one that would actually go up with inflation. So even though it's a fixed payment, it would go up every year with that. Like, if there's 2% increase in the RBA cash rate, depending on what type of annuity you've got, you can actually keep it going up with inflation. Now you can have an annuity, and most annuities would just pay you straight away as soon as you've set it up. From the next month, it would start paying you, or next quarter, or whatever you've set it up for, and you can have it paid immediately. Or you can get what they call a deferred annuity, which is you can actually get it to start somewhere in the future. Now, the idea of this is the fact that you could indeed say, well, okay, look, I've got my superannuation money, and that's going to do me okay, but I'm a bit concerned it's sort of not going to last me the distance, and the speed I'm taking it out at is probably only going to last me 15 years. So you could have a deferred annuity that you could basically, it will start obviously in 15 years' time. Now, obviously you get better rates for all of that, and it's just giving you some certainty that you're not going to outlast your money over time. It's always, those sort of things are always very, very hard to work out as far as whether it's a good idea or not, because we just don't know what we're going to do, how long we're going to live, how much money we're going to need in 15, 20, 30 years' time. So a bit difficult, but we certainly do have flexibility in your start date if for some reason or other that's what you want or believe would be a sensible thing for you to do. So all in all, quite a powerful little investment. There are some annuities where if you were to die, no money would go to the estate. That's becoming unusual these days. Most of the annuities, there is a death benefit just depending on how long you've been on the annuity for. So these are the sort of questions you need to find out if you are obviously concerned about estate planning issues. You'd need to find out what's the story. If I was to pass away in year 1, how much money would go to my estate? How much would go to my estate if I passed away in year 15? And so it goes on. Is there any money left to go to my partner? As I say, you can have these things basically rolled into, it's not rolled, but effectively paying the partner on your death as well. Challenger is a company that specialises, probably one of the biggest companies in Australia dealing with annuities, and on their website, challenger.com.au, there's some really good information. And if you just to Google annuities, you'd come up with all the different companies that would do it. But I suggest you obviously, before you jump into any one company, certainly find out what type of annuity you want, but then get some quotes, because the quotes won't all be the same. depending on what they believe interest rates are going to do and the type of annuity they're offering and the other bits and pieces to it, the numbers could certainly change. So get quotes before you jump in, and if you need any more help to understand it, obviously get in touch with us and we'll guide you through annuities. We'll talk to you on further sessions.